Bitcoin has just broken its all-time high, and it's no wonder. Spot Bitcoin ETFs have served as rocket fuel for BTC's price. Countries are adding it to their national reserves, and more companies than ever are holding BTC on their balance sheets. However, while it seems like Bitcoin is going from strength to strength, many have questioned whether this concentrated accumulation of BTC is good for Bitcoin, or whether it poses new threats.
It's a threat.
A threat.
A recent article by one of crypto's sharpest minds tackles this head on. So today, we're breaking this article down in simple terms and exploring what could be next for Bitcoin. My name is Nick, and you're watching the Coin Bureau. Now, before we begin, you need to know that I am not a financial advisor and nothing in this video should be considered financial or investment advice. This is purely educational content delivered to you with that classic Coin Bureau charm. So, if that sounds good to you, punch those like and subscribe buttons, smash that notification bell, and let's dive in. Okay, the article we'll be summarizing today is titled, quote, "The Rise of Bitcoin Stocks and Bonds," which was written by Lyn Alden, a widely respected voice in macro and crypto. We've linked to the full article in the description below and highly recommend giving it a read when you have the time. Now, the article begins by saying that although Michael Saylor's strategy first adopted Bitcoin in 2020, broader corporate adoption was initially slow. Today, this is changing in a big way, and the companies that embraced Bitcoin at scale early on have since seen their market caps and stock prices explode. Alden then answers the obvious question of why investors would invest in a company holding BTC rather than BTC directly. And the first reason is that many portfolio managers may be bullish on Bitcoin, but are restricted to working to a specific mandate. So, for example, a stock portfolio manager can only invest in stocks. However, if a company holds Bitcoin, the stock portfolio manager can gain exposure to BTC's price action by investing in a Bitcoin treasury company. A clear example is Strategy's MSTR, which has surged since the firm first bought Bitcoin. And because it's a much smaller market cap, MSTR has often outperformed Bitcoin's price action itself. The second reason is that companies with strong conviction in Bitcoin often use leverage to accumulate more Bitcoin. As she explains, quote, "Publicly traded operating corporations have access to better types of leverage than hedge funds and most other types of capital. Specifically, they have the ability to issue corporate bonds." Put simply, corporations can borrow money for asset purchases, aiming to boost their returns. But if asset prices fall too far, they risk a margin call, which is an urgent demand to pay part of the loan, which can of course force them to sell at a loss, even if they strongly believe in that asset. It's not ideal. The good news is that this setup means corporations can issue long-term bonds to raise capital without selling their Bitcoin. So, if BTC's price drops, they're under less pressure to sell at a loss. Essentially, since they aren't dependent on short-term loans tied to Bitcoin's value, they're better equipped to ride out Bitcoin's volatility. Notably, Alden points out that over the long term, corporate bond leverage is often superior to leveraged ETFs, and that's because leveraged ETFs rely on short-term leverage that resets daily, which drags down performance, often causing them to significantly underperform their non-leveraged counterparts. However, assets with longer duration leverage attached typically don't have these same troubles. It's quite the opposite, actually. When BTC is appreciating and has multi-year duration debt attached to it, this can be a powerful combination for Bitcoin treasury companies to maximize their returns. Alden adds that, quote, "Not everyone should take on leverage, but those who do will naturally want to do it in the most optimal way." And as luck would have it, there are now lots of Bitcoin treasury companies, each with varying risk profiles, volatility, and jurisdictions. And this range provides investors with ways to get the type of volatility exposure that suits them. The next section of Lyn Alden's article explores whether corporations support or undermine Bitcoin's mission. Answering this hinges on 2 points: the steps decentralized money must take to gain adoption, and whether corporations help or hinder that process. To help answer this, Alden cites a 2010 quote from Satoshi Nakamoto on the Bitcoin Talk forum. Quote, "As a thought experiment, imagine there was a base metal as scarce as gold, but with the following properties. Boring gray in color, not a good conductor of electricity, not particularly strong, but not ductile or easily malleable either, not useful for any practical or ornamental purpose, and one special magical property can be transported over a communications channel. If it is somehow acquired any value at all for whatever reason, then anyone wanting to transfer wealth over a long distance could buy some, transmit it, and have the recipient sell it." End quote. Alden explains that while Bitcoin found early success, it soon faced unexpected disruption from altcoins. And these revealed that despite Bitcoin's unique strengths, there are infinite ways to transfer money on-chain. And the launch of stablecoins in 2014 intensified this competition by enabling value transfers without the volatility. And that actually reminds me, if you're looking to buy or trade BTC or altcoins, then you need to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cashbacks on deposits of up to 75% on the best crypto exchanges around. You see, these deals, they won't be around for long, so take advantage of them ASAP using the link down below or by scanning this QR code. Now, Alden notes that over time it became obvious that as more people held BTC, the easier it was to use. That's because Bitcoin's network effect had helped it self-reinforce as money. In this sense, Alden identifies two types of money that Bitcoin could have become: situational money and ubiquitous money. In a nutshell, situational money solves specific problems, like cross-border transfers or bypassing restrictions. It's useful in certain contexts, but doesn't ensure broad or lasting adoption. Conversely, ubiquitous money is widely accepted within a region or industry and held as a cash balance, rather than immediately sold or exchanged. Crucially, people see it as a reliable store of value and seek to accumulate more of it. Investors typically buy it expecting appreciation, so they don't need convincing to accept it as a payment method either. Alden then highlights Bitcoin's major success as a sound, portable store of value that holders can spend or exchange. And this is thanks to its architecture, its proof-of-work consensus mechanism, fixed supply, simplicity, decentralization, and first-mover advantage are all key factors that have earned its reputation as sound money. But here's where things get interesting. Alden explains that Bitcoin sits in the gray area between situational money and ubiquitous money. That's because, unlike situational money, many people will hold Bitcoin long-term. But it's also unlike ubiquitous money since it's not yet widely accepted. She adds that, quote, "The reason it takes a long time to go through that stage is due to volatility and due to the sheer size of the existing network effect it is up against that people have their expenses and liabilities denominated in." And this ties into how far we are into Bitcoin's adoption phase. Alden's article notes that while BTC's price continues to fluctuate by large swings at a time, Bitcoin remains a flawed form of near-term money. She gives the example of paying rent, where neither the tenant nor the landlord can really afford Bitcoin to drop by 20% in a month. As such, Bitcoin is mainly viewed as an investment. Hardcore enthusiasts and those without access to cash are more likely to use Bitcoin for payments, though the latter would probably prefer stablecoins. As the article notes, centralization matters less if the stablecoins are only used short-term. Alden adds that while some enthusiasts encourage holders to spend their BTC, this practice isn't sustainable. For Bitcoin to handle trillions of dollars in medium of exchange transactions, it would need to solve challenges other solutions currently already address, which isn't the case at this stage of Bitcoin's adoption. As such, Alden advises enthusiasts to keep educating others while managing expectations, acknowledging that broader economic factors mean change won't happen overnight. And this highlights the importance of optionality. the ability to store BTC portably and convert it to other currencies whenever needed. In this sense, Bitcoin was already successful, especially compared to other currencies. While the US dollar, euro, and assets like gold and silver are widely accepted and easily converted, most others are far less usable. Among the top 10 global currencies, Alden ranks Bitcoin between 5th and 10th, which is not really bad for a currency still in its teens. Alden then answers other frequently asked questions, starting with whether Bitcoin's users are still using it as a money if they're not transacting with it, to which she answers yes. And that's because simply holding Bitcoin technically counts as using it. While it may not be ubiquitous money, it functions as situational money and portable capital. The next question asks when Bitcoin's usage will take off as a medium of exchange. Alden answers this by saying, quote, likely not until it's an order of magnitude larger and less volatile. BTC currently only makes up roughly 0.2% of global assets and is incredibly volatile. Since ubiquitous money is typically held, store of value use usually comes before medium of exchange use. Alden notes that stablecoins are better suited as crypto's medium of exchange. The catch is that most are centralized, making them subject to control, censorship, and even confiscation. And this ties into the next question, which asks whether Bitcoin is too volatile to be money. Alden answers yes and no. Bitcoin itself isn't inherently volatile. Its qualities are sound and persistent. The volatility comes from the people who adopt and explore it. While upward volatility is needed for Bitcoin to gain traction, this also brings downside volatility. And that's why BTC is mainly treated as a long-term investment for now. However, as adoption grows, volatility in either direction should diminish. The final question asks how Bitcoin can be its own asset when priced in dollars. Alden explains that BTC can be priced in any currency. Nothing in Bitcoin's code ties it to dollars, and it's often priced in other currencies and even other cryptos. Dollars are the most commonly used simply because they're the world's largest and most liquid asset. She explains that the dollar was once pegged to gold, but as the dollar grew dominant, gold became primarily priced in dollars. Bitcoin is far from reaching that level, and it's unlikely most goods will be priced in BTC anytime soon. But this isn't necessarily a flaw. Bitcoin is still in its growth phase. Next, Alden examines how corporations fit into Bitcoin's adoption journey. She cites a 2014 article by Pierre Rochard, which envisioned entities borrowing money to accumulate BTC back when BTC was just $600. I know, if only we had a time machine, eh? Today, Bitcoin is far more liquid, boasting a market cap of over $2 trillion. Wall Street is embracing it, and there are billions of dollars worth of corporate bonds issued solely for holding BTC. The question is this good or bad for the Bitcoin network? Alden identifies two main groups skeptical about this trend. The first champions self-sovereignty, often rooted in cypherpunk values. They see custodians as a threat to Bitcoin's core principles and have dubbed corporate treasury companies as suit coiners. Advocating self-custody, they warn that custodial rehypothecation undermines Bitcoin's role as a freedom money. The second group consists of critics who refuse to change their stance, despite Bitcoin's growing success. Some of these even argue that Bitcoin only succeeds because the Federal Reserve has printed so much money, which is ironically one of the main reasons to be bullish on Bitcoin. Alden responds to both camps by saying that, quote, just because some large pools of capital choose to hold Bitcoin, it does not mean that free-range Bitcoin is in any way impaired. Put simply, Bitcoin still works as it always has, and the more entities that hold it, the easier it becomes to use as a peer-to-peer money. Some also claim that Bitcoin is failing because governments, corporations, and institutions have captured it. In reality, this adoption was always inevitable for Bitcoin to reach a global scale. Alden then explains why by outlining 3 eras Bitcoin has gone through so far. Era 1, the super early user era, was back when people mined Bitcoin on laptops, Mt. Gox was the sole exchange, and wallets and hardware were incredibly primitive. Era 2, the retail era. It came after the collapse of Mt. Gox, and this was when more exchanges became available and the first hardware wallets were introduced in 2014. Era 3 is where we're at right now, and this is where Bitcoin has become a major asset class. Institutional-grade infrastructure is being built, publicly traded companies are holding BTC, ETFs offer indirect exposure to its price, and even nation-states are adding it to their reserves. That's one hell of a story arc for an asset that's just 16 years old. Importantly, though, the key proponents of each era haven't been lost. We can still mine or buy BTC freely, and self-custody has never been easier. Crucially, though, Bitcoin isn't just for corporations. It remains an open, permissionless system accessible to anyone with an internet connection. Now, the final part of the report looks at the risks and opportunities presented in the corporate era. Alden begins by reiterating that, quote, at a surface level, the question of whether corporations are good or bad for Bitcoin is almost irrelevant because they're inevitable for Bitcoin at this scale. She adds that, quote, if Bitcoin can't succeed if corporations or governments buy it, then it was never going to succeed. That would be like when aliens invade Earth in a fiction story and end up losing because they are vulnerable to water, signs, or can't deal with basic germs, the war of the worlds. It was just never meant to be. That's an interesting take, to say the least. Regardless, though, this does still leave a few questions unanswered, namely whether corporations accumulating BTC present a risk to the network, and whether these risks can be mitigated. Put differently, does the growing centralization of BTC's supply threaten its growth? Well, according to Alden, these fears are overblown for one very good reason. Bitcoin is a proof-of-work network, not a proof-of-stake. And this means that holding, say, 100,000 BTC grants no more power over the network than holding 0.1 BTC. Neither amount can allow a holder to censor transactions or manipulate the network. Alden adds that large amounts of BTC being held by a single entity isn't a new thing either. Mt. Gox was at one point holding around 850,000 BTC, and wallets belonging to Satoshi Nakamoto collectively hold over 1 million mined BTC between them. And this was back when BTC's supply was roughly half of what it is today. Alden wisely notes that, quote, critics of large institutional and sovereign owners of Bitcoin can and should call out bad practices wherever they exist. People can and should support or donate to legal causes or software development for areas of interest to them that benefit smaller users. Just like any public good, it's reliant on millions of individual actors working on the aspects that matter to them. Well said indeed. So, what opportunities do Bitcoin treasury companies offer then? Well, the most obvious benefit is that more people than ever can gain exposure to BTC, whether through leveraged treasury firms or spot Bitcoin ETFs. And this also helps investors avoid risky casino-style altcoin marketing and reduces the chances of them getting wrecked. Alden notes that while many investors chase altcoins for their volatility and short-term upside, Bitcoin companies offer a more direct and often better way to gain high beta exposure to BTC. And for ever greater risk and reward, investors can even buy leveraged positions in these companies' stocks. And that brings us to the end of the article. And remember, you can find the full piece in the description below, and we encourage you to give it a read. For now, though, there's just one question remaining. What's next for Bitcoin adoption and the crypto market? Well, so long as BTC's price keeps climbing, more companies and institutions will be drawn into adding it to their balance sheets. We're already seeing more companies adopting Bitcoin than ever before, and this trend is showing no signs of slowing down. Nearly every company growing its Bitcoin treasury is doing so by issuing convertible debt, often earmarked solely for BTC purchases. And this creates a positive MNAV, which stands for multiple of net asset value. In plain English, a positive MNAV means the company is outperforming BTC itself, making its stock highly attractive to investors. The risk here, of course, is that the later these companies are into the game, the worse the terms will be for financing this hoarding of BTC. And this means they're naturally more at risk of liquidating their holdings if Bitcoin's price takes a dip. And this could cause a knock-on effect that drives prices down further and could even cause enough panic to spark the next bear market. Yikes. The other risk is more obvious, and that's Bitcoin's growing supply concentration. Simply put, if any major holder dumps their massive BTC stash, it could crash the price. And this has sparked concerns that this increased centralization clashes with Bitcoin's core principles. However, it's important to remember that Bitcoin's protocol doesn't limit how much BTC any one entity can hold, and its price going down wouldn't destroy Bitcoin, as history has shown time and time again. In any case, there's no denying that the institutional adoption of Bitcoin is enormously bullish, and as Bitcoin reaches new all-time highs, it seems that Bitcoin dominance could finally begin to fall. And this means that all eyes are on the altcoin market, which is long overdue for a major rally of its own. So buckle up, folks. It might be about to get wild. Okay, if you enjoyed that video, you'll love our latest one, which you can watch right over here. And if you're not subscribed to the channel, you can do that right over here. This is me for now. Thank you guys very much for watching, and I'll see you again soon.